You're here because you want to get up to speed, right? Understand complex stuff quickly without getting totally overwhelmed. You're looking for that shortcut to really knowing your stuff. And that's exactly what we're doing today. We are taking a deep dive into sustainable finance. Think of this as your personal guide through this really vital and honestly fast changing area where finance meets, well, hopefully a better future.
Exactly. And we've looked at quite a range of sources for you. Things like um, basic documents explaining sustainable finance itself, comparing CSR and ESG. We'll get into that. We've also got a chart showing the, frankly, amazing growth of sustainable investment in Switzerland, plus descriptions of different sustainable investing standards, info from Swiss Sustainable Finance, and a look at how complicated ESG ratings can be, using Total Energies as a case study. And finally, we touch on the role of central banks, especially the Swiss National Bank, and this idea of market neutrality.
Okay, so our mission here is pretty clear. Pull out the key insights from all that material. We want to clarify the jargon, point out the big trends, and also tackle the challenges. By the end of this, you should have a much sharper picture of what sustainable finance is all about, and maybe more importantly, why it actually matters to you. All right, let's dive in. What exactly is sustainable finance? What are we talking about here?
Well, at its core, it's really about deliberately thinking about environmental, social, and governance factors. You'll hear that acronym ESG a lot when making financial decisions. The main goal is, to channel investment towards economic activities, towards projects that are sustainable over the long haul, responsible, viable activities.
Okay, ESG. So those are the building blocks. Let's break them down. First, environmental. What's included there?
Right, the EA looks at how investments affect the planet, basically. So yeah, climate change, carbon emissions are big ones, but it's also about how we use resources, pollution levels, biodiversity, that kind of thing, the whole impact on the natural environment.
Makes sense. And S for social, what does that cover?
The S is about the impact on people, on society. It's pretty broad, actually. It covers things like working conditions, labor rights, human rights, generally both within the company and, importantly, in its supply chain. And also how a company interacts with the communities where it operates, its social footprint, if you like.
And the final piece, G, governance. That sounds like it's about how the company is actually managed.
Exactly right. Governance is about the systems, the rules, the processes for running and controlling companies. So think about transparency, ethical behavior, how the board is structured, is it independent, what are the rights of shareholders. These three, environment, social governance, they really form the bedrock of sustainable finance.
Okay. Now, I remember before ESG became such a buzzword, we heard a lot about CSR, corporate social responsibility. Are they just different labels for the same thing, or?
That's a really good question. And yeah, it causes a lot of confusion. It's important to see the difference. While both CSR and ESG aim for businesses to be more responsible, they come at it from slightly different angles. CSR is, well, generally more about a company's voluntary actions, things they choose to do for positive social or environmental impact. It's often driven by their own internal values, maybe wanting a better reputation, doing good for employees or the local community. Think charity, community projects, that sort of thing. And the reporting. It tends to be more qualitative, less strictly regulated. It's about going beyond just the legal minimums.
Right. So CSR feels more like it comes from within the company, less about external pressure.
That's a good way to put it. ESG, on the other hand, is much more focused on criteria you can actually measure and report on, across those E, S, and G pillars we just talked about. And the drivers for ESG are often external. We're talking international standards, government rules, and this is key, pressure from investors. Investors increasingly want to see this data to manage risks and spot opportunities. So ESG reporting is usually quantitative, data-heavy, and it's becoming mandatory in and more places, especially if you want investment or operate in certain markets. The term ESG really took off around 2004, and it signals a more structured, often more regulated approach than CSR generally was.
Okay. Our sources pulled out some key differences. If you, the listener, had to remember just a couple of things distinguishing CSR and ESG, what would they be?
I'd say two things stand out. First, there's a phrase, ESG is with a big G. That really highlights how much more important formal governance structures are in ESG compared to maybe traditional CSR. Second, while both terms kind of emerged around the same time, like 2004, showing this growing awareness, the main difference is really why and where they're used. CSR, often internal values, voluntary stuff. ESG, much more about external expectations, demands for measurable data. especially from investors and regulators.
That distinction is super helpful. Okay, shifting gears a bit. One source had this chart showing just how much sustainable investment has grown, specifically in Switzerland. What was the big story there?
Yeah, the story is pretty dramatic growth. The scale and speed were just, well, remarkable. Back in 2009, the total amount managed using sustainable strategies in Switzerland was around CHF 32.4 billion. Fast forward to 2019, and that number had exploded to CHF 1,163.3 billion. That's over a trillion Swiss francs.
Wow, wait, over a trillion in just 10 years.
A trillion. Yeah, it's huge. It shows this massive shift driven by, greater awareness, yes, but also supportive policies in Switzerland and organizations like Swiss Sustainable Finance really pushing it. Switzerland's become a major hub for this.
That rate of growth is just staggering. The chart showed a huge jump recently too, right?
Absolutely. Just between 2018 and 2019 alone, it jumped by 62%, a massive increase in just 1 year. And the chart broke it down a bit into funds, mandates, assets held by asset owners, and basically all categories grew strongly. But funds and these managed mandates saw particularly rapid growth towards the end of that period. The clear trend is just this accelerating adoption of sustainability criteria right across the Swiss investment landscape, especially taking off after about 2015.
Okay, so you have all this money flooding into things labeled sustainable. That raises a pretty big question for you, the listener. How do you actually know if something is sustainable when you see that label?
That's exactly the problem these sustainable investing standards and labels are trying to solve. Their main job is to give investors a trustworthy way to spot and compare financial products that are genuinely trying to meet sustainability goals. They set minimum standards, push for more transparency about what's actually in the portfolio and how it's managed, and importantly, try to combat greenwashing.
Ah, yes, greenwashing. Where something looks green but maybe isn't underneath.
Precisely. Marketing something as sustainable when it doesn't really stack up. These standards aim to prevent that.
Our sources mentioned quite a few different standards. Could you maybe give us a quick tour of some key ones just to get a feel for the landscape?
Sure. Yeah, there are quite a few out there developed by different organizations, often with slightly different focuses or levels of strictness. For example, you've got the Febelfin Quality Standard and Label in Belgium. It sets a kind of baseline for sustainability, and it's open to products from Belgium and elsewhere. Then there's the F&G label, mostly used in German-speaking countries. This one's stricter. It explicitly excludes things like nuclear power and weapons, and requires companies to follow the UN Global Compact. F&G also offers these sustainability profiles and a transparency matrix tools to help you dig deeper and compare how different funds approach sustainability.
Okay, so different levels of rigor already. Any others?
Yes, absolutely. Luxembourg has the LuxFlag ESG label. Its goal is to assure investors that the product is genuinely investing responsibly. LuxFlag actually has several specialized labels too, focusing on specific areas like microfinance, environment, climate finance, green bonds, alongside a general ESG one. Then up north, the Nordic Swan Eco label for investment funds is known for being very strict. It has a long list of exclusions, fossil fuels, weapons, tobacco, and more. Plus, it demands minimum ESG practices for everything the fund holds, requires active engagement with companies, and mandates public reporting of holdings.
Wow, that does sound tough.
It is. And in France, you've got the Greenfin label, which focuses specifically on environmental criteria, certifying funds contributing to the green transition, and also the label ISR, which takes a broader, socially responsible investment approach.
So it's definitely not a one-size-fits-all situation, a real patchwork of standards.
It really is. Different focuses, different rules. But the overall idea, the benefit, is to provide these credible, transparent frameworks. They help investors make choices that hopefully align with their values, cut through some of the marketing noise, and ideally avoid that greenwashing problem.
Right. Now, another organization mentioned was Swiss Sustainable Finance, SSF. What role do they play in this Swiss ecosystem we were just talking about?
SSF is an independent association set up back in 2014. Their main goal is pretty ambitious: to make Switzerland a top global center for sustainable finance. They work on that by, well, informing people, educating the market, and generally supporting the spread of sustainability principles throughout the Swiss financial world.
So they're kind of a connector, a promoter, like a central hub for this stuff in Switzerland.
Exactly. That's a great way to describe it. They act as this key platform. They bring together all sorts of members, banks, asset managers, insurers, pension funds, but also universities, NGOs, even government bodies. It's about fostering collaboration, sharing knowledge, figuring out best practices together, driving expertise in Switzerland. And the fact they grew to over 250 members in their first decade, that really shows the momentum and their importance in Switzerland's shift towards a more sustainable economy.
Okay, so there's definitely momentum, lots of growth, organizations pushing things forward, but our sources also flagged that the ESG ratings, the things meant to help investors assess companies, can be pretty, well, messy.
Messy is a good word for it. Yeah, that's a very accurate take. The ESG ratings world is, frankly, quite complex and not particularly well organized. You have a whole load of different rating agencies, data providers.
Yeah.
They come from different backgrounds. And crucially, they use very different methods, different methodologies to score companies on ESG.
Different methods mean different results, I guess.
Exactly. There's no single standard. So the same company can get quite different ESG ratings from different agencies. Makes comparing them really tricky. And just the sheer number of ratings out there. One source mentioned over 600 different ESG ratings and rankings globally back in 2018, and it's only grown since then. You can see how that creates confusion, both for investors trying to use the ratings and for companies trying to understand how they're being judged.
That complexity really jumps out when we look at the specific example provided. Total Energies, a huge oil and gas company. The question was, can a company like that really be seen as a top ESG performer? It seems counterintuitive.
It does seem counterintuitive, and that's precisely why it's such a good case study. The answer, based on the ratings, is, well, it's complicated. It really depends on which agency you ask and how they weigh different factors. Different agencies look at total energies through their own lens, using their own methods and data, often to help investors compare it to its peers or the wider market.
So what did the ratings actually say? This was for 2021, right?
Yes, for 2021. Well, MSCI ESG gave Total Energies an AA rating. That's actually quite high on their scale. Sustainalytics rated their ESG risk as medium, but importantly noted their score was better than the average for oil and gas companies. ISS ESG gave them an A+, again indicating they performed better than many competitors. S&P Global ESG scored them 81 out of 100, also higher than the oil and gas average. Refinitiv gave them 90, which is well above their peer average. And even CDP, focusing just on climate and water, gave them an A rating, suggesting strong performance there too.
Hold on, so AA, A+, 8190. Despite being a major fossil fuel producer, they're getting pretty high marks across the board.
Relatively speaking, yes, often outperforming their direct competitors in the oil and gas sector. The comparison charts sometimes showed them scoring closer to utility companies than other oil majors. It really throws the complexities of ESG ratings into sharp relief, doesn't it? It shows that even a company whose core business seems problematic from one environmental angle can still score highly based on the specific criteria and weighting used by different agencies. It highlights the different perspectives and methodologies at play.
Okay, that's a really important nuance. Let's broaden the lens now to some really big players in the financial system. Central banks, what's their basic job?
Well, central banks are essentially the stewards of a country's money and financial system. Their main goals are usually about keeping prices stable, controlling inflation, and supporting the overall economy, keeping it healthy and stable.
Our sources compared the Swiss National Bank, the SNB, with the U.S. Federal Reserve, the Fed. What's the key difference in what they prioritize?
The big difference is in their core mandate. The SNB's #1 job, above all else, is price stability for the whole Swiss economy. If other goals conflict with that, price stability wins. It's a very clear primary focus. The Fed, however, has what's called a dual mandate from the U.S. Congress. They have to aim for both maximum employment and price stability. Plus, they try to keep long-term interest rates moderate. So the Fed is constantly juggling those two main goals.
Two goals versus one primary one. Okay. And how do central banks like the SNB actually do their job? What tools do they use?
They have a few main tools in their kit. Setting interest rates is a big one. The SNB calls this its policy rate. Changing that rate affects borrowing costs across the economy. They also buy and sell government debt on the open market. That's a way to influence the amount of money circulating. Another key thing is managing liquidity in the banking system, making sure banks have enough cash. This can involve creating money electronically or buying and selling other assets like commercial debt, maybe even shares, equities. And because they do all this buying and selling, they end up holding large portfolios of assets.
Right. And this is where that term market neutrality came up in the context of the SNB. What does that mean for them?
Yeah, market neutrality is supposed to be a guiding principle. For a central bank like the SNB, it means when they buy assets, say, bonds, or equities as part of their policy operations, they try not to pick winners. They aim to reflect the overall market structure, not to favor specific companies or specific sectors. The idea is to avoid distorting market prices or giving anyone an unfair advantage.
Okay, avoid picking winners. Now, the sources also gave us a peek into the SMB's actual investment strategy. How do they tend to spread their assets?
Well, a huge chunk is in foreign currency reserves. Mostly US dollars, about 39%, and euros, around 37%. Smaller amounts in Japanese yen, British pounds, Canadian dollars, etc. In terms of what they buy with that foreign currency, it's heavily weighted towards government bonds, about 64%. These are generally seen as safe. Around 11% is in other types of bonds, and interestingly, about 25% is in equities, in shares. They specifically mentioned not investing directly in banks, though.
And the quality of those bonds.
Very high, mostly. About a third AAA, almost half AA rated, so predominantly very safe government debt. The sources also showed how the SMB's total assets, especially those foreign currency investments, really ballooned after the 2008-2009 financial crisis, likely linked to managing the Swiss franc exchange rate, although the chart did show a bit of a decrease more recently in those foreign holdings.
Okay, so big holdings, mainly foreign currency, heavily invested in safe government bonds, but also a decent chunk in equities. And it grew a lot post-crisis. Now, let's connect this back to that idea of market neutrality. You said the aim is to avoid distorting markets, but how does that square with this huge push towards sustainable investing we've been talking about? Is there a tension there?
That is exactly the tension at the heart of a big debate right now. On one hand, you have this principle of market neutrality, don't interfere, just reflect the market. But on the other hand, the reality is, when a central bank buys billions worth of assets, its choices do have an impact. Who they buy from, what sectors they implicitly support. It affects borrowing costs, it sends signals. So when you bring in sustainability, the conflict becomes really clear. If a central bank sticks rigidly to market neutrality, mirroring the current market, it might end up holding large amounts of bonds or shares from companies with poor environmental records, simply because those companies are big market players. They're essentially supporting the status quo.
Which could include supporting unsustainable activities.
Potentially, yes. So the debate is, should central banks maybe rethink strict market neutrality? Should they actively tilt their portfolios towards sustainable investments, like green bonds? Or even go further and start excluding the worst polluters, even if that means not perfectly reflecting the market anymore. It's a live discussion. What role should these incredibly powerful institutions play in steering finance towards sustainability?
It really sounds like a balancing act, maybe even a fundamental conflict between this traditional hands-off principle and the urgent need to tackle things like climate change through the financial system.
It absolutely is. And it just underscores how complex and dynamic this whole sustainable finance area is. Understanding these different pieces, the definitions, the growth drivers, the challenges with standards and ratings, the evolving role of big players like central banks, it's really crucial if you want to navigate the future of investment and, well, economic development generally.
And it definitely makes you, the listener, think harder about what we even mean by sustainable in finance, given all these different standards and the influence of these huge institutions.
Definitely. And it leads to that bigger question. Considering how much influence central banks inevitably have, is true market neutrality even possible? Or is it more a question of consciously choosing how to direct that financial power? Should they be actively shaping a more sustainable future?
What is the right role for them? That's a really potent thought to leave things on. If this has sparked your interest, we definitely encourage you to dig deeper, maybe look into some of those specific standards we mentioned, or check out the ESG performance of companies you care about. There's a lot more to explore, building on the foundation we've hopefully laid out in this deep dive today.